Everybody online is suddenly screaming the same thing right now. 1-to-1 risk to reward is better than 1-to-3. You see it in thumbnails, you hear it in shorts, people are calling out old trading wisdom like it is a scam. And here is the funny part. They are right for maybe 90% of traders. But this video is not for the 90%. This video is for the small group who feel something different when they hear that. The ones who think, I understand why 1-to-1 is safer. But I also know I am not built like most traders. I am okay with being wrong more often if the winners are worth it. If that thought lives somewhere in your head, then keep listening, because you might be part of the 10% of traders who can actually make a 1-to-3 risk to reward approach work. And if you are, the worst thing you can do is blindly copy the new 1-to-1 trend when you were secretly built for something else. So let me set the frame very clearly so you can trust me. I am not here to tell you that 1-to-3 is better for everyone. That would be a lie. For most retail traders, a simple 1-to-1 risk to reward with a decent win rate, tight risk management, and discipline will beat their old chaotic trading. If you are impulsive, emotional, and still struggling to follow basic rules, 1-to-1 is absolutely your best friend. But there is a tiny group, the 10%, whose psychology, strategy, and patience are more aligned with hunting bigger moves and living with a lower win percentage. For them, forcing a 1-to-1 framework can actually kill their edge. Let me show you what I mean with a story. Meet two traders, Ethan and Maya. Ethan is a classic 1-to-1 sniper. He likes being right. He hates long losing streaks. When he sees 5 red trades in a row, his entire body tightens. He starts questioning his intelligence, his strategy, his life choices. So for him, 1-to-1 is perfect. He chooses clean setups, gets in, takes profit at a realistic level, and moves on. His win percentage is high enough that his confidence stays stable. Maya is different. Maya is a trend hunter. She hates taking small profits and watching the market run for another 3 times that distance without her. When she back-tested her setups, she saw something interesting. Her entries were often early in larger trends. If she took profit at 1-to-1, she left a huge amount of potential money on the table. When she tested taking partial profits at 1-to-1 and letting the rest run to 2, 3, sometimes more, her account grew more, even though she was right less often. Now imagine both of them watching the new wave of content telling them 1-to-1 risk to reward is better than 1-to-3. Ethan hears that and feels relief. It matches his nature. Maya hears that and feels frustrated. It does not match what her data shows or how she actually thinks. If you are like Maya, this video is your permission slip to explore that side of trading. Not recklessly, not emotionally, but with structure. Let us first understand why everyone is suddenly in love with 1-to-1. Then we will talk about where 1-to-3 shines and what type of trader can truly handle it. The reason 1-to-1 has become popular is simple. Most new traders are terrible at handling losing streaks. They chase insane risk to reward ratios with terrible entries, and then they emotionally explode when they get 8, 10, 12 losing trades in a row. On paper, a system that risks 1 and makes 3 looks incredible. In reality, that system usually comes with a lower win percentage. If you cannot survive long stretches of being wrong, the math on your screen does not matter because you will not live long enough emotionally or financially to see it pay off. So education channels started saying, stop playing the hero, take 1-to-1, aim for more frequent wins, build confidence, learn discipline. That wave of advice is actually very good for the typical emotional retail trader. But here is the nuance no one talks about. There is another side to the story. Imagine you have a strategy that genuinely catches strong moves. Maybe you trade breakouts from well-defined ranges. Maybe you are good at spotting early entries into trends on higher time frames. When you backtest honestly, you notice something. Your best trades do not just move 1 unit in your favor and then die. They often go 2, 3, sometimes more. When you force all of those trades into 1-to-1 targets, you are choosing comfort over potential. You are capping your upside so that your win percentage feels good. That is like having a job where you get paid the same for working 1 hour as for working 12 hours. At some point, that trade does not make sense anymore. Now, before your ego gets too excited, listen carefully. Bigger reward is not free. When you go from 1 to 1 to 1 to 3, three things change immediately. First, your time in the market per trade usually increases. That means more exposure to news spikes, random volatility, and emotional swings. Second, your sequence of wins and losses changes. You win less often. Your account might sit in a drawdown for longer stretches, even while your edge is completely fine. Third, your discipline requirements skyrocket. You cannot start taking random trades and expect the math to save you. The math only works for you if you play the same game over and over and over again. This is why I say only about 10% of traders should seriously lean into 1 to 3 as their main play. You have to be the type of person who can handle being wrong often without losing your mind, who can sit in a winning trade without grabbing the first small profit, and who can stare at days with no setups without forcing anything. Let me take you inside a week in the life of a 1 to 3 trader. It is Monday. Maya sits down at her desk, coffee in hand. She knows exactly what she is looking for. She is not trading every tiny move. She wants a very specific context, a clear trend, a clean pullback, a certain reaction at a level. She scans the charts. Nothing matches. The old version of her would have taken 3 impulsive trades by now. The current version closes the platform after 2 hours and does not trade. Emotionally, it is uncomfortable. There is a voice in her head saying, "You did nothing today. Are you even a real trader?" But she ignores it. Tuesday, a potential setup appears. The market trends, pulls back into her area, shows a reaction. This is what she has been waiting for. She takes the trade, risks her fixed small amount, and places her target at 3 times that distance. The trade moves in her favor, almost reaching 2 times her risk, then pulls back. At 1 time her risk, she could take profit and feel good. But she knows from her testing that the big edge comes from letting some trades reach the full 3. She watches the retracement flatten out, the trend continue, and finally, her target is hit. All of the patience, all of the boring hours pay off in 1 trade. Wednesday and Thursday, nothing. Flat, choppy, ugly price action. She does not force anything. No trade is also a decision. Friday, she sees another setup. It looks good. She enters. The market fakes out and slaps her stop. She takes the loss and logs it. Her weekends with 1 solid winner, 1 loser, and 3 days of no trades. On paper, that might only be a net gain of 2 times her risk for the week. Not spectacular. But as she repeats this over months, the combination of fewer trades, bigger winners, and controlled risk creates a very healthy equity curve. Now compare that to the average trader chasing 1 to 3 without the mindset. They would have taken 10 trades that week, all over the place, all claimed as 1 to 3 ideas, but exited early, moved stops around, and ended up break even or worse. The difference is not the ratio, it is the human. So, if you are still watching, you probably feel something in this. Maybe your natural tendency is already closer to Maya. You are not obsessed with being right on every trade. You care more about the overall picture. You are comfortable with the idea that your trading month can be made by just a handful of big moves, as long as you survive the rest. Here is how to approach 1 to 3 risk to reward like a professional, not like a gambler looking for a lottery ticket. The first thing you need is evidence. Gut feeling is not enough. If you think your strategy fits 1 to 3, go back over a large sample of past setups and ask a simple question. If I had taken profit at 1 to 1, what would my results look like? If I had aimed for 3 times my risk, what would they look like? Do not cheat. Do not cherry pick only the best examples. Include the ugly ones, the sideways ones, the almost break-even ones. You might discover that your system actually performs better with a middle ground, like taking partial profit at 1 to 1 and letting the rest run to 2 or 3. You might discover that pure 1 to 3 actually wins you more in the long run, but comes with deeper temporary drawdowns. Now you have data instead of dreams. The second thing is structure. A 1 to 3 approach without fixed risk per trade is asking for disaster. If you want to play this game, your risk per trade needs to be absolutely fixed as a tiny piece of your account. Think in terms of losing 10, 15, maybe 20 trades in a row without blowing up. That does not mean you will, but you want your account to be able to survive that. Because long losing streaks happen more often in strategies that rely on higher reward. The third thing is environment. 1 to 3 reward makes more sense in markets that actually move. If you are trying to squeeze 3 times your risk inside a tiny range with no volatility, you are asking the market to do something that is statistically unlikely. Higher reward trades usually shine in trending environments, breakouts from clear structures, or major reversals with momentum. That means you need some way to identify context, not just signals. The fourth thing is honesty. A lot of traders say they aim for 1 to 3, but in practice, they constantly cut trades at 1 to 1 because they are scared, or they move their targets further when they are excited, or they bail completely at the first sign of red. That is not a 1 to 3 system. That is emotional trading with a nice label. If you decide to pursue this, you owe it to yourself to actually monitor how many trades truly reach your planned target versus how many you sabotage on the way. Now let me speak directly to your ego for a second because this is important. It is very tempting to say, I am definitely in the 10%. I can handle it. I am built different. Every trader wants to believe they are the exception. That is why so many people blow up accounts. The real flex is not claiming you belong to the 10%. The real flex is having the patience and humility to prove it. If you genuinely are that trader, you will not be scared by the idea of testing your approach over 100 trades. You will not be offended by the idea of starting with smaller size. You will not feel attacked by drawdowns because you understand that they are part of the game you chose. You will not need to show your wins to strangers online because your account growth over time will be enough. And here is the twist. Even if you are not part of that 10% yet, the process of trying to be will make you infinitely better, even if you decide that 1 to 1 is where you belong, because you will learn to respect risk, to define your edge, to sit on your hands when there is no setup, and to stop worshiping every single trade. In the end, the debate between 1 to 1 and 1 to 3 is not really about numbers. It is about identity. Do you want to be the trader who desperately needs to be right all the time, or the trader who is okay being wrong often? Because the few right moments change everything. Neither is morally superior. Both can make money if done correctly. But if you pick the wrong identity for your psychology, you will suffer. So here is the real message of this video. For most retail traders, 1 to 1 risk to reward is absolutely the better starting point. It gives more frequent wins, smoother equity, less emotional chaos, and a more forgiving learning curve. About 90% of people watching this should probably live there for a while. But for a small group, the 10% who can handle longer waits, harsher emotional swings, and who can back their decisions with real data, 1 to 3 is not a fantasy. It is a weapon. Used correctly, that weapon lets them do in a few trades what others chase in dozens. If you feel that pull towards 1 to 3, do not ignore it. Just do not romanticize it either. Respect it. Build around it. Test it. And be honest enough with yourself to admit whether you truly thrive in that world or whether you just liked the sound of it. Because at the end of the day, the market does not pay you for trading the ratio that is trending on social media. It pays you for trading the ratio that actually fits your edge and your brain. For 90% of traders, that is 1 to 1. For 10%, it might just be 1 to 3. The question is not which side you want to be on. The question is which side you are truly built for.